My personal checklist for finding great stocks, great companies with plenty of growth behind them, ahead of them, and finding those companies at a great value. This is an easy checklist. This is for if you're new to the stock market, maybe you've just been in for a few years. I've been doing this for 15 plus years, and I've been very successful in the last 8 to 10 years, averaging 25% returns in my stock portfolio. That being said, I'm not a financial advisor, so take everything I have to say with a grain of salt. This is my personal experience. This is my checklist, and I hope you can learn from it. This is Investing by Numbers. My name is Trey. We talk about stock market investing, stocks, learning, all that stuff. So if you're into that kind of thing, please subscribe to the channel. We go over stocks. We look for stocks at great values. I tell you what I'm buying every month for my portfolio, stocks I might be selling, all that stuff. So also like the video if you get any good information out of this. That really helps a new channel like this one. We've only been around for a few months now. And this type of video is my favorite to make because this is really where the rubber meets the road. Sometimes looking for a great stock to invest in can be very overwhelming if you're not 100% sure of all the things to look for. So this is exciting. This is a lot of fun. And if you find investing in stocks interesting, you'll find this video interesting as well. But before we get into the list, I want to talk about a couple things. For one, the purpose of investing in individual stocks, individual companies, is to outperform the index funds of the market like the S&P or the NASDAQ. But also it carries with it a lot more risk. Okay, guys? So that is very important. Index funds like the S&P, they follow the broad market. So the downside risk is pretty minimal. You will see some big dips in the S&P index, but over time it continues to push to all new highs, over the years for the long term. Individual stocks now can go bankrupt, they can go out of business, you can lose all your money. So a lot more risk involved, which is why it's that much more important to learn what to look for. Think of this as when you invest in a stock, think about the people around you that you know. Some people are very successful, they seem like they've got it all together, they've got a nice house, nice car, maybe a nice family, and then we all know some other people, maybe they're family members, people went to high school with, that have had a rough go of things. Maybe they've been in trouble with the law, they can't hold down a job, maybe they've got some addiction issues. So think about investing in a stock like investing in the people you know. The people that you want to invest in are the people that are doing really well in life. Let me give you one more thing. Sometimes the people we think are doing really well in life aren't doing as great as they seem. Obviously, in real life, we can't look at someone's bank account. We can't look at their paychecks. We can't see how much debt they have. These aren't things people are just willingly going to give you, on the street or over dinner. So the great thing about stocks are we can see all that information, guys. We can look at all the balance sheets. We can see basically the company's bank account. We can see how much growth they've had the past few years, how much growth they're predicted to do over the next few quarters or a couple years. And all this information helps us gather the information we need to make a good choice about whether this company is a growing company that's doing well and expanding, and also if this company is a good value, in that is the stock price worth a good value. Sometimes a great company can be very overvalued in price, and in that situation, sometimes if you don't know what to look for, you might buy too expensive and you might actually lose money over a year, 2, 3 years. Sometimes you buy at the top and a stock will drop because it's already overvalued, and the big money on Wall Street knows that, and so they sell it off and you're stuck holding it at a very high price. Sometimes it'll just run sideways and not really lose or make money for years. So this video is going to show you how I look for value, a very easy way to do it. So let's get into the list. Here we go. Okay, guys, number 1, a company needs to have been trading on the market for 5+ years. This is an easy one. Basically, the reason for this is we need at least 5 years of data to be able to look at to make an educated decision on whether this company has plenty of growth behind them, and then possibly if they have growth ahead of them as well. And also it takes a few years usually for a company to reach positive net income growth. And so generally 5+ years is what we need to see so that we have steady, reliable information at our fingertips to make a good decision. So how do we find that information? Basically, one of the easiest ways you can do, this one's pretty straightforward. You can go under whatever trading platform, online, any stock website. But if you have Robinhood like I do, you can just click on the max button, and obviously this thing goes back all the way to the year 2000. So bingo, that is over 5 years, obviously. So that's, the easiest way to do it. Most of the time this one's pretty straightforward. Number 2 is company needs to have positive net income for 4 quarters or more that has steady long-term forward growth. So how do we do that? We're going to come up here and we're going to come to macrotrends.net. That's the site I like to look for doing my stock research. You might have your own site that you like to use, but this is the one that I enjoy using. Scroll down to stock research, and up here we're going to push, click in NVIDIA, type in, and you can just click on revenue. So we come down here to this page, ignore the pop-ups, there'll be plenty. You come to revenue and profit to find net income, and down here there is the net income button. So we scroll down, and right here in the middle we've got quarterly net income growth. Now, positive net income growth per quarter will be obviously a bar going up. If it was negative income, it would be going down. Obviously back here we have one, but we got more than 4 quarters of positive net income here. And forward growing, we want to see this graph going up and to the right. And that's what we see here. This is a great graph that shows ongoing quarterly net income growth. Now, if we had a bar that was down and maybe plateaued and then went back up, that's fine. We just want to see in general long-term steady growth. It's okay if the most recent quarter isn't the highest one. That's okay. And we'll look at some more examples of that later on in the video when we get to some full examples here. So what is net income? Net income is basically the amount of money a company profits after everything is paid. So for instance, after employees are paid, after all the bills are paid, after the product or they need to make their product is paid for, it's basically just the extra money left over after everything has been paid for. So it is the profit, and that's net income. And this is a big factor in how to value a company, is how much profit they produce per quarter and ongoing. And we, if we're buying a good company, we want to see that number growing over time and generating more profits in of net income. Number 3 is company needs to have steady long-term revenue growth. This is similar to the net income growth, but this is also a good factor as well. This is basically the amount of money coming through the front door. So if you have a lemonade stand and someone pays you $5 for a fresh squeezed lemonade, that $5 is your revenue. All right. Your net income would be whatever's left of that $5 after, lemons, the stand, how much you paid your workers, how much was left of that $5 at the end. So revenue is, of course, just the money coming through the front door of a business or company. So let's look at the same thing here for revenue. We scroll up, we click on revenue and profit, and then we click on revenue right here, and we'll pull up a similar graph as the net income was. Right here in the middle, we have quarterly revenue, and this is exactly what we want to see is ongoing, improving revenue growth. And same as net income, if you have some quarters here that are lower than others, or if the most recent quarter isn't the top, that's okay. We just want to see this thing growing over time, because companies that have been around a long time, they'll have plateaus. They'll have, a year or two or whatever where they might make a little less, but generally with good companies over time, they continue to improve. So that's what we want to see. That's a great graph for revenue. Number 4 is company needs to have a good balance sheet. All right. So there's 2 parts to this. A balance sheet is basically their bank account statement. It shows us how much assets they have, how much debt they have. It shows how much cash on hand they have, and it shows revenue coming in and all kinds of stuff like that. But there's 2 big things I like to look for. You can get as complicated as you want with a balance sheet, but we're keeping things easy here on this checklist, just the main bullet points to get you in the ballpark of finding great companies at a great value. So part A is we want to see steady ongoing cash on hand growth. So let's check that out. Coming over here to macro trends again. Up here, what we want to click on is financials. All right, financials, and then down here we click on balance sheet. So, a lot of information here, but we're looking at cash on hand. We want to see steady cash on hand growth. So we click on cash on hand right here, and it'll show us a graph like the others we've looked at, which is I really like to see. It's an easy way to look at how much growth they have moving in the past. So fantastic. I mean, just like net income and revenue, this is okay. You have spikes and dips, and this doesn't have to be, the newest bar doesn't have to be the highest bar. We just want to see this number improving over time. It's okay if they had a dip here, as long as it's still kind of going up and to the right. So fantastic graph for cash on hand. This shows us that they have more cash coming in and they're saving cash. And this is what a company will use to acquire other businesses, pay off debt. I mean, just like in your bank account, this is the cash they have to do whatever they want with. And a good company usually is going to make good decisions, and the cash they use is usually something that will give them a positive return on their investment and generate their company more money. All right, so number 4, part B, is at least 50% or more total assets to total liabilities on the balance sheet. And let's check out that. I'll show you how to find this as well. We're going to come back to the balance sheet. Once again, we can go to financials, click on balance sheet, and scroll down. Obviously, our cash on hand was at the very top. So this makes it pretty easy. Total assets is right here. This is $111 billion of total assets. And down here we have total liabilities, $32 billion. This is a fantastic ratio of assets to liabilities. So liabilities is just all the debt the company has. This could be short-term, long-term debt, what they owe that they have not paid yet. So, and obviously total assets is cash on hand plus, what their product and businesses are worth, like basically what their buildings are worth, all of the things they own, what their worth is. So this is, all obviously not liquid money, but it's what the company's worth minus what they owe. So I like to see 50% or more total assets, total liabilities. So the minimum I'd want to see here would be 32.3 billion times 1.5, which would be somewhere around like 48 to 49 billion. But we've got way more than that. We've got 111 billion here. So that's like over a 3x, 300% there. So that's fantastic. Another thing you can look at that's an extra point here is cash on hand, how much of the debt that covers. So we've got 43 billion in cash. This would easily cover the 32 billion in total liabilities they have, and they would still have 10 billion of cash left over. So you would say right now we don't have any necessarily, we don't have debt. Our cash can cover our debt here with NVIDIA. This is an A+ balance sheet. I mean, there's not many balance sheets that are much better than this. This is fantastic. This is what we like to see. Obviously, as we get further into this, we'll go over some examples of balance sheets that are not so good as well. Okay, before getting into part 5, if you've got checklists for whatever company you're looking for all the first 4, this is a great opportunity to add that stock to your watch list, because if you've got check marks through 1 through 4, this just shows that it's a good company. Number 5 is all about value and finding a good value. So just because it's a good company doesn't mean it's necessarily a buy. We want to see the value and the price is right. So number 5, company has to be trading at a good value. Part A is under a 50 PE, which is a price to earnings ratio. Basically, this is a number, and it is the stock price divided by the last 4 quarters earnings per share. And that gives us a PE ratio. It gives us a number, a multiple. So if we're looking for under a 50 PE. Obviously, I find it easier and more reliable to come to Yahoo Finance. Just come in here, click in the stock ticker. We're looking at NVIDIA, and this is the first screen you come to. And you can come right down here to PE ratio, and right now we're just over a 41. So we are under a 50. So that checks that part A. Now, if you want to come to macro trends, you click on price ratios, and then you click on PE ratio. And scroll on down, and we see a graph here. The top is the stock price over time, and the bottom is the PE ratio over time as it reflects to that stock price. And if you're looking at this, you can see the history. We go back to all the way to 2010. We were trading at around 12, 13 back here in 2013. But then the last 5 years, it has been trading over a 50 for a while. We got just under a 50, and just lately we've been under a 50. So I personally, to just get the immediate today's PE ratio, I like to go to Yahoo Finance and look at this PE ratio here. It's a 41. Obviously, if you go to macro trends, so this hasn't updated. This is saying it's a 52. I can tell you exactly what that is. When companies release their quarterly earnings, sometimes it takes a few days for certain websites to update the new earnings to their data, and that affects the PE ratio. So I've found that Yahoo Finance is a little more consistent. They're a little quicker to update their stuff. So that's what I'd like to look at for a PE. Now, why do we want under a 50? So basically, the higher the PE ratio, the more expensive a stock is trading, the lower, the cheaper. It is a ratio. Now, a lot of companies that have been around a long time that don't have as much growth trade a little cheaper. Nike and Hershey's, they may trade in the 20s on average for PEs, and companies like Tesla and NVIDIA, AMD, these companies have a lot of growth going on. They trade more expensive. The issue is the higher the PE, if the market goes into a crash, or if that company reports bad earnings for a couple quarters in a row, the further down the price will drop, okay? Because the less likely the smart money is to be buying at those high levels. So for instance, back in 2022, Tesla was trading at a super high PE, and they had a couple of hiccup quarters where growth was decreasing, and their stock price over the course of a year dropped like 75%, which is huge. So this is why we like to just, no matter what, stay under a 50. It adds protection. And even most companies, that are high growth companies, if you wait, a lot of times, you might be able to get them under a 50, and when they do dip below a 50, and these are the companies having super, high growth, double-digit, percentage growth year over year, when they get under a 50, they're usually a good value. So number 5, part B, is we want a historically low PE for that specific company. So just kind of like we were looking at here, I like to use macro trends for this. We're obviously looking at NVIDIA right now, and I like to go to the last 10 years. So right now we're going back about 15. So I moved this little cursor here to around the 2015 mark. So now we're looking from just at January 2015 up until now. Now I know, because I'm a little experienced, that NVIDIA the past few years is a different company than what it was, 10 years ago. So back then it was trading cheaper. It was trading at a lower PE. But the past 5 years, this thing has stayed above a 50 PE. We had a quick moment here where it barely got under a 50 in 2022, and that was during the 2022 stock crash. And of course, it jumped up pretty high up here, and then it leveled out again. And just recently, over the past couple months or month or so, we've seen it drop down below a 50. Obviously, the last earnings report for NVIDIA was fantastic. Their numbers are getting better. So the reason we're seeing this is some of the market sell-off that's been going on. We've kind of hit that just into a market correction. And so even though NVIDIA's numbers are great, their stock price is going down. That is a great thing for us investors. So now we're right around, a 40 PE on this thing. And, looking at this thing, for me, being a little more liberal with it, I would say, yeah, anything under a 50 is a great place to buy. If you want to be a little more conservative, obviously back then in 2019, it dropped all the way down to a 21. Maybe you would say, well, I'd rather be on the safer side. I'll buy anything under, a 40. So it just depends on your level of tolerance. But generally, I would say if you're a beginner, go for these lower places. Like if you're looking at this graph for the first time and you weren't as experienced to look at the growth numbers, on the income statement, maybe you would say anything under, a 35 or a 40 would be a buying point. And, if it drops all the way under 20, then great. You're getting more shares for a cheaper value. And this is what this is about, guys. If a stock market crash happens, companies like NVIDIA, their stock price drops just because the overall market's dropping. Their numbers still might be doing pretty good. So this is the point where if you have experience, you're getting an even better deal. And so you're not afraid to buy even though the stock price is dropping. You're buying a good company at a good deal. And if it takes it a year to come back up, you just keep picking up as many shares as possible. And in the next 5 years, you should be sitting on a good profit. That's how we like to invest in these companies. So NVIDIA, obviously a new company, it's going to trade a little richer. Let's look at a company like Nike for the PE ratio. Nike obviously has been, I think, traded since like the 1980s. I think it's been a company since the 1960s. So their growth is going to be a lot slower year over year than NVIDIA. Which is a newer company with, that's software based or hardware based, I should say. They're a chip maker, not software. So looking back again, we can see the stock price for the last 15 years of Nike. The last couple of years, Nike's had a rough go of it. They've had a CEO change. They've tried some things that didn't work out. So they've been their stock price got pretty high up here. And as you can see down here at the PE ratio, we see these big spikes in PE ratio. This is kind of almost a sign that things are getting a little overvalued here with the company. So I want to look at the last 10 years. I'll slide this to 2015. And I really just want to look at the dips in this PE ratio graph down here. Obviously over here, we got down to 20, a 19. Right here was around a 30. Obviously, this was kind of a high point. And then we started dipping down. We had a 29 and 23. And right now we're somewhere in the low 20s. Let's check out Yahoo Finance and see what it has to say. Nike. PE ratio of 22. Okay, so right now we're at a 22, obviously under 50. And historically, 19 there. We're looking really good. 20. I actually do own Nike. I've got a decent position in Nike, and I still like the price it's at. Right now, I am buying up NVIDIA and a couple of other stocks to build bigger positions in them. But as those positions grow, I really like the price of Nike right now. Obviously, they've had some hiccups. If you look at their numbers, growth has kind of plateaued or gone a little negative lately. But a company like Nike, also trading under a 20 PE, they've got staying power. And that's why I like looking at historical growth, because even if this thing drops down to a 10, which would be cut in half from where it is now, I would still keep buying Nike. Is it possible for a company like Nike to make a bunch of bad decisions and eventually go bankrupt? It is. It totally is possible. But if you're looking at the balance sheet, if you're looking at the steady revenue and net income growth they've had over decades, they've got a track record. And so I feel safe, when a company like Nike goes through, a rough year, and I feel good looking at this, seeing that it's trading cheaper PE-wise than it ever has in the past 10 years. I feel good about buying it. Now, if it was trading at a 45, obviously, I wouldn't be wanting to buy that because that's higher than the P ratio is. But a 20 PE is still looking good for Nike. Even though they're going through troubles, they're still putting up profits. They're still bringing in revenue. So I like that price. And if I was trying to make a decision on Nike, I would say I'd be willing to buy anything under, if I was playing it conservative, a 25. If I was going a little liberal, maybe a 27, 28, maybe a 30. But definitely under a 25, maybe up to a 27, and I would just keep buying in that range. If it went really low, I'd keep buying, and that's that. All right, so let's check out Tesla. Tesla's a hot stock right now. It's seen a 50% decline just about over the past couple months. So max chart, we can go all the way back here to 2010. Obviously, that's more than 5 years, so that checks the box for number one. And number one, obviously, was company needs to have been trading on the market for 5 or more years. Now, number two, we want positive net income for the last 4 quarters or more, and we want it to be steady long term. So let's look at the net income for Tesla. I've got Tesla pulled up here on macro trends, revenue and profit, net income. Let's scroll on down here, down to quarterly. So yes, we got 4 quarters here of positive net income growth. Now, we do have net income growth that's up and to the right. This is getting into iffy territory for me. Obviously, we are doing better than 10 years ago, but the past, couple years have been a little inconsistent. So I would give this a check mark, but it's almost into neutral territory for me. But I would still give this a check mark since we do, over time it is positive growth, but the last year has been significantly lower than the year before it. So if this goes on for another couple quarters, I would not give this a check. Okay, so revenue. Number 3 is company needs to have steady long-term revenue growth. So we'll come over here to revenue, and we'll look at the same thing. Here we go. This is quarterly. This is okay to me. All right. Revenue growth is a check. Even though we've kind of plateaued over the last couple of years for revenue growth, this is still fine. This is still up and to the right. I'm okay with a plateau. Companies go through that. So this is a check mark for me. Obviously, if the last few quarters were way down here, it would not be, but they're up here. It has been flat for a couple of years, but that's okay. That's a check for revenue. Number 4. We're on the balance sheet. We want to see steady, ongoing cash on hand growth, and we want to see 50% or more of total assets to total liabilities. All right, so scrolling back up here to financials and balance sheet, and we're going to click on cash on hand. And yeah. Great cash on hand growth for Tesla. They're doing this right for sure. This is a fantastic graph for cash on hand. So that's a check mark there for part A of number 4. Let's go back to look at the rest of the balance sheet. All right, total assets, total liabilities. We've got 122 billion of total assets, and we've got 48 billion of total liabilities. This is good. I mean, this gives us a check for part B as well. We've got, almost 2.5 times more total assets, total liabilities. So that's definitely over 50%. So good balance sheet here. Cash on hand is 36 billion. It doesn't quite cover the 48 billion, but I'd give this, an A to an A minus balance sheet. So probably an A. I mean, it's a good balance sheet. The only thing that would bring it up to an A plus would be if we had more than 48 billion here in cash on hand. But still, hey, check mark for number 4, A and B. So at this point, this is a good time, to add something like Tesla to your watch list. Obviously, net income, keep an eye on that. Tesla has had a rough last year. Numbers have been down for them. But now let's check out part 5 to see if Tesla is a good value historically in relativity to the PE ratio, and if it's below a 50. Now, so this is a great chart to look at because we were not profitable until right into 2020. So for all this time, we had a 0 PE ratio because Tesla was not a profitable company. And you'll see this a lot when a company hits profitability right in the beginning, the PE ratio will skyrocket and then level out. So this is also, why we want to be buying just under a 50. You just want to be careful with this stuff because it takes some time when a company goes into profitability mode, that it takes their PE ratio time to level out. And then it takes a little more experience once it starts dropping to really be able to know what a company should be trading at. But let's look at the last, we'll just pull the 2020 since it was profitable here. All right, so obviously we went super high in 2020, and then we came down. I mean, even though this is getting really low, we're still at an 80, 34. We did get down to a 34 in 2022. But is it right now? This is saying 121. Let's come over here to Yahoo Finance and look at Tesla. This will give us a more accurate PE ratio. All right, we're at almost 122 PE. So this does not check the box for us. This is still pretty high. And the crazy thing is Tesla's stock price has dropped significantly. So we're still pretty expensive here for a PE ratio, and this is in relativity to the net income coming through. Obviously, they've had some difficulties in net income the past years, so that's why even though the stock price is down, the PE ratio is up, and that is just more protection for us. This thing, I want to see it under a 50. It's well over that. It's not a 50. And if it was, and I was looking at this chart, obviously back here we got down to a 34, 45 around here, 55, and we're high now. For me, even if it was under 50, definitely under 50. If not, if I was looking at this, I would probably say maybe under a 45, since we got down to a 34 here and we got just under a 45 here. If you're being a little more liberal with it, you could say 50, and if you're being more conservative, 40 to 45. But I think under a 50 is decent for Tesla. I mean, Tesla's got a great balance sheet. They've got good revenue growth, but they're struggling a little bit with net income, and that is what we're seeing here with PE ratio, because net income and the price to earnings ratio work together, and when net income drops, the PE ratio is going to go up. And so that's just keeping things safe for us to stay under a 50. Even though the stock price has dropped, I'm not liking that number right now. Obviously a rough year for Tesla. If they were to, get through this rough patch and get that P ratio kind of leveled out again, then we'd make another decision. Let's look at one more. Let's check out Amazon. Amazon's a good one of the Mag 7 stocks. First thing we want to know is, has it been trading for 5 or more years? Yes, it has. That's an easy thing to look up. The next thing we want to look at is the companies that have positive net income for 4 or more quarters that has steady long-term forward growth. All right, so let's come back over here to macro trends and we'll come down to net income. And so let's look at these last 4 quarters of net income growth. So yeah, we've got more than 4 quarters of net income growth. And we also want to see this going up and to the right over time, and we do. Obviously, we had a dip here, but we recovered. If we reversed back to this point, this would have made me nervous to invest in Amazon at the time, especially if you're a beginner, because this can, with a company as big as Amazon, this is usually just kind of, some growing pains. But with other companies, this could be the sign of decreasing fundamentals, negative fundamentals, and this could be a sign that the company might be headed in a bad direction. But, with successful companies, they go through these phases. And right now, if we were looking to invest in Amazon, this is a great graph for net income growth. So number 3 is revenue growth. And yeah, quarterly looks great. Quarterly is looking perfect. This is a great graph for that. Got great, steady revenue growth. Part 4 is the balance sheet. All right. The first thing we want to look at is cash on hand. All right. Yeah. Great cash on hand. Obviously, we had a dip here. That's okay. And we've recovered to all new highs this previous quarter. So great cash on hand. Let's come back to the balance sheet. And let's look at assets to liabilities. We want to see 50% or more total assets to total liabilities. We have almost 625 billion of total assets, and we've got 339 billion of total liabilities. So this is almost 2 times, not quite, probably around 90% more. So that's definitely over 50%. So that's good. I mean, I'm good with that. A company like Amazon that's got, a lot of warehouses and stuff like that all over, the country and the world, they're going to have a lot more liabilities. So, that's why I go to 50% or more. Certain companies, are a lot more software based. They don't have near as many employees. So they're going to have, a better ratio. But even with a brick and mortar, type of company, I still want to see 50% or more. That's just the safe number for me. I really like to see a double up, but my minimum is 50% or more. So good balance sheet. I mean, the cash on hand is 100 billion. That's only, that's still under a third. It's probably about a quarter of the total liabilities. So, I give Amazon's balance sheet like, a C plus. It's just average. It's a decent average balance sheet, but it still checks the boxes. So we're doing good. So for number 4, that gets us through. So Amazon at this point, if you're looking at Amazon, it's a great time to add it to your watch list. And now we'll try to see if it's a good value. So once again, let's make sure the PE is under a 50. And we're going to do that on Yahoo Finance. Yahoo Finance, like I said earlier, it's just got more accurate PE ratio numbers. So we're at just under a 36 PE. So part A, check. And let's come back over here to macro trends. So this number up here at the top, this was pretty close, but it wasn't exact. But in the past, I've noticed macro trends, sometimes this number is off. So that's why I've just found that Amazon is just more accurate. Personally, for me, a lot of times I will calculate the PE ratio myself. Sometimes if a company has just released earnings, these numbers haven't updated yet, because when a company releases earnings, that will affect the PE ratio. For the better or for the worse, or it can kind of stay the same. So a lot of times I will calculate it myself, but that's for another video. If you're new and a beginner, I would stick with Yahoo Finance. That's usually going to be your most accurate. All right, so let's look at the PE ratio historically down here. I like the last 10 years, so I'm going to scroll here to 2015. Obviously, we had a huge height here of 718. Now, this came after having a 0. And like I said earlier, sometimes when we have, and we saw that with the net income, when the net income goes negative for a quarter or two, this affects the PE ratio like crazy. So then when it becomes positive, it goes really high. And then it takes a few quarters for it to balance out as the company goes back into a more steady profit growth. So here we've got, obviously it was really high back here, and it's kind of leveled out, over the past 5 years or so. Still high here. We had I like to look at the dips. Obviously right here we had a dip of 51. We had another little hiccup here where we had some negative net income and went to a 0, and we jumped up to a 245. But so here was a 51, and then over the past, couple years, we got down to a 46, a 39. So this is the past, year or so since 2024. Amazon's really been decreasing their PE ratio. Now, this can happen because as a company ages, its growth slows. But, this is still, under 50 historically has been a good place to buy Amazon. Now, and just because growth is slowing, of course, maybe a 40 or 45 may be better. But generally, this thing is low enough right now where I would say, anything under if I was looking at this today and I was looking at just most recently, I would say, anything under, since we've gotten all the way down to the mid 30s, I would say anything under a 40 right now is a good buy for Amazon. And historically, Even if their, growth is slowing, we're still at, historically low PE ranges. And for a huge company like Amazon, being in the 30s, I know this from experience, is, an okay place to be for their numbers. So I think Amazon's a buy right now. Obviously, it's not a huge dip, but I want to see a dip in price. But, really what we're looking at, guys, is how much net income we have per share in relativity to the stock price. Our PE ratio is an easy indicator of what things are worth. And you can look at different companies, and this is where you can practice. Just look at different companies and get a feel for, companies' net income and their PE ratios and their revenue growth. This checklist, it's just, kind of a guide. It'll get you 90% of the way there. If you're doing this for looking for stocks, you're already ahead of 90% of the retail investors out there that are just kind of picking whatever they want. Some people will just, if a stock is just going up and up and up, they'll buy it just because everyone else is, and that's a bad way to invest. Some people will just buy anything with a dip. That's also a bad way to invest. Looking at these PE ratios is a great way to look at, value. And I'll go a little further. We'll give some extra credit here. If we come to financials, now this is a little bit more intricate if you're a newbie. But if we come to the income statement, we can see years of numbers here. So we've got, 2019 into 2020, and we see revenue here, and we can see, and this is for Amazon, revenue growth. Obviously, we had 280 billion in 2019, and then we, probably about 50% more into 2020 to 386 billion, and then another pretty big jump to 469. Not as big of a jump into 2022, not as big of a jump into 2023. We're starting to balance out a little bit, but the past 3 years were a little slower than the 3 years before it. So that's what we're looking at here when we're seeing the PE ratios start to balance out, come down a little bit, and that's okay. And net income down here, you can also see the numbers: 11 billion, a double up to 21 billion, 50% jump to 33 billion. But then into 2022, we had a huge decrease here. But then we caught back up and kind of had, still down a little bit from the previous year, but we got back into net income growth. In this past year, we had a pretty big jump in net income from 30 billion to almost 60 billion. So almost a double up in net income from 2023 into 2024. So, that's a great number too to look at. So that's a little bit, a step above what we have been looking at with the checklist. So if you get really good at the checklist, that's what I would start looking at here. But every company is a little different. A company like Nike, they're going to have less big growth than a company like Amazon or Nvidia that are a little newer, that are experiencing high growth cycles. So let's check it out. So obviously in 2019 and 2020, we had decrease for Nike. Then we had, roughly a 20% move or so into 2021. And then we had just about a 5% move into 2022, maybe 10% into 2023, and then into 2024 was just kind of a break-even year. We had barely any growth there. Down here at net income, we had a decrease into 2020, but then we had a double up into 2021. We had about 5% growth net income in 2022. We had a decrease into 2023 for net income, and just about 10 to 15% growth of net income into 2024. So we can see that with a company like Nike, these growths are different, and that's why Nike is trading at a lower PE than something like an Amazon or an Nvidia. Those Amazon and Nvidia, they trade well above a 50, whereas a Nike, trades under a 30, like it trades in the 20s. So with experience, you can kind of look at these numbers here and kind of start to understand, with relativity to the net income growth, revenue growth of the past few years, about what range makes the most sense for companies. but keeping under a 50 will give you a lot of protection. I mean, some companies with extreme growth, could you justify paying more than 50 PE for the stock? Sure, you definitely could, but I like to keep it under 50 because I'm looking for a good deal. And the higher PE ratio, the more move it has to the downside if we have a stock crash or if the company has a bad year. When the company has a bad year and they're trading really expensive at a really high PE, they drop a ton. They can have, we saw a 75% drop in Tesla's price back in 2022. So this stuff can happen. That's why I like to keep things under a 50. I like to look at the historical move, and that helps you kind of understand where a stock should be trading. Okay, guys, that's the end of this video. Thanks for tuning in. It's kind of been a long one, but there's a lot of information there. Feel free to go back through, watch it again, copy the list for yourself, get some practice in, looking at stocks and researching them, going through the checklist. If you have any questions, comment down below. I respond to every question. I try to respond to every comment. And if you like this kind of content, please subscribe to the channel, like the video. Liking videos for small channels like us really help out. It really pushes us into get more growth for the channel, and that's what we like to see. Obviously, we're all about growth. So on that, thanks for tuning in, and we will see you on the next video.